Banks often mislead us with a significant falsehood: the idea that our money flourishes within our bank accounts. However, the reality is quite different. While money accumulates in numerical terms due to interest, it fails to grow in actual value or keep up with inflation. This situation leaves us with bank interest rates significantly lagging behind. In essence, having funds stored in the bank can be likened to a leak in your pocket. This video intends to unveil 6 assets that counter this erosion of wealth, enabling you to construct lasting generational prosperity. Hit that subscribe button, join our community, and embark on a journey towards lasting generational prosperity. Welcome to our channel, where we transform knowledge into wealth. 1. Divine assets: gold, silver, and platinum. The intrinsic value of money is largely attributed to its capacity to retain worth for the future. Nevertheless, modern governments resort to printing more money to fulfill their deficits, casting doubt on the stability of the currency. This uncertainty is precisely why financial experts advise investing in genuinely precious resources that possess scarcity and cannot be effortlessly replicated. It is this very principle that motivates the affluent to consistently allocate a portion of their portfolio to precious metals. The surge of inflation is often the catalyst for the perpetual appreciation of precious metals like gold, silver, and platinum. Rewinding to the pre-1950s era, a mere $400 could secure an ounce of gold. Fast forward to 2023, and that very same ounce commands a price exceeding $2,000. Prime XBT's gold forecast even suggests a potential ascent to $10,000 by 2032. This implies that within a decade, your gold investments could quintuple in value. As cash continues its descent, the trajectory for gold remains upward. This principle extends to other precious metals as well, making them superior alternatives to stashing cash in a bank account. If you're pondering how to incorporate gold exposure into your portfolio, sans physical acquisition, consider investing in gold exchange-traded funds, ETFs. These cost-effective investment instruments yield returns based on gold price fluctuations, without necessitating physical ownership. 2. Industrial commodities: embracing raw materials. Scarcity forms the bedrock of precious metals' status, rendering them invaluable. Beyond this, their innate utility value solidifies their indispensability. The realm of industrial commodities, epitomized by silver, propels innovation across sectors like electronics, medical equipment, and nuclear reactors. Similarly, cobalt, nickel, and copper enjoy immense industrial demand due to their intrinsic attributes that defy replication by alternative materials. Offering a vivid snapshot, the cobalt's demand has soared since 2020, driven by its pivotal role in electric vehicle battery production. In line with this, its value has surged from $20,000 per ton in 2012 to a staggering $40,000 in 2022, an impressive 100% surge in a mere decade. This underscores the immense potential for portfolio enhancement during periods of high demand. Alas, not everyone can allocate substantial sums to raw material acquisition, and the logistical challenges of storage and trade can deter engagement. Hence, diversifying via mining company stocks such as Rio Tinto, mining-focused mutual funds, or derivatives like futures and options emerges as a prudent strategy to seize exposure in this domain. 3. Stable currency havens. Amidst the contemporary landscape of fiat currencies, devoid of gold backing, the paramount significance of geopolitical stability becomes evident in the realm of investment. This explains why affluent individuals tend to harbor their wealth in Swiss banks. Switzerland, boasting one of the world's most resilient economic frameworks, provides a haven of tranquility on the geopolitical front. Consequently, the Swiss franc emerges as a cherished safe haven during periods of upheaval and uncertainty. This phenomenon has been witnessed repeatedly, evident during episodes like the Eurozone debt crisis in 2009 and the global financial turmoil of 2008. Notably, substantial capital streams have gravitated toward Switzerland from afflicted nations to shield their assets from the corrosive effects of currency devaluation. Moreover, the Swiss franc doubles as a valuable surrogate for the US dollar in international trade. A telling instance unfolds during the recent Russia-Ukraine crisis. As the United States imposed sanctions on Russian energy trade, Russia sought refuge in Swiss francs for conducting transactions. This consequential development spurred unprecedented demand for the Swiss franc, propelling its valuation vis-à-vis all other currencies in early 2023. The upshot: a single Swiss franc commanded a hefty 1.1074 US dollars, fostering overnight prosperity for Swiss franc holders. In light of these attributes, currencies of exceptional stability, like the Swiss franc, British pound, and Chinese yuan, emerge as reservoirs of enduring value. While not everyone has the privilege to establish Swiss bank accounts, accessible alternatives abound. Currency exchange-traded funds, ETFs, and forex brokers, such as Forex.com, cater to the needs of smaller investors by facilitating currency exposure with a modest entry point as low as $100. 4. Assured government backing. Take a closer look at the dollar, and you'll find the words, "This note is legal tender for all debts, public and private." Have you ever pondered its significance? Back in 1971, when President Nixon dismantled the gold standard, the dollar transitioned into legal tender under U.S. law. This transformation endowed it with value as a medium of exchange, and we began regarding it as a fitting repayment for goods and services. While no fiat currency globally is tethered to gold or any tangible asset, they still derive their worth from the unwavering trust and credit of the governing body. To put it simply, the stability of your money is intertwined with the stability of the government that supports it. Consequently, the wisdom in investing in sovereign guarantees becomes evident. Governments typically stand as the ultimate bulwark against defaults. A government's faltering could cascade into a nationwide default scenario, an outcome no robust administration would permit. Thus, delving into sovereign guarantees entails a safety net. A recommended path is through government securities, known as GSECs. However, it's prudent to opt for GSECs issued by stable governments boasting investment-grade credit ratings. The specter of the 2009 sovereign debt crisis in Greece serves as a reminder. Multiple interventions by entities like the IMF, Eurogroup, and ECB were necessary to extricate the nation from its debt quagmire. Consequently, while engaging with GSECs, a government's global robustness should remain a central consideration. In the United States, avenues for gaining exposure to sovereign guarantees are accessible. Treasury bills, notes, and bonds present options with superior returns compared to leaving funds idling in bank accounts. These financial instruments rest on the bedrock of the U.S. government's robust standing in the global economic landscape. Aspiring investors with modest means can directly procure Treasury securities from the government via the Treasury Direct platform or the secondary market. 5. Value-centric equities and mutual funds. Unquestionably, Treasury investments wield greater returns than idle cash. Yet, while they flaunt the allure of low risk, they inevitably proffer returns that fall below the vibrancy of stocks. A profound embrace of risk, while pivotal for the cautious investor, is shadowed by an insatiable thirst for amplified returns, a quest shared by the broader investment community. Within this dynamic realm, stocks emerge as a potent vehicle for gratifying this quest. This stock universe, however, is far from monolithic in riskiness. It bifurcates into two prominent categories: value stocks and growth stocks. The latter, a cohort encompassing technology stocks, dangles on the precipice of risk due to their association with innovative concepts and technologies bearing the specter of high failure probabilities. On the contrary, value stocks, Nucor for instance, operating within the realm of industrial metals, exude a more stable disposition. This arises from their association with a steadfast demand projection for the foreseeable horizon. Consequently, value stocks, anchored by robust fundamentals, furnish not only the solace of consistent and measured price appreciation, but also the reassurance of dividends that stand firm. Yet, the meticulous scrutiny of the bedrock principles underpinning each value stock poses an arduous journey, especially for the average investor. In response, dividend-centric mutual funds enter the scene as an astute solution. Take, for instance, the Vanguard High Dividend Yield Index Fund Admiral Shares, a compelling choice blessed with a lineage of dependable dividend payouts. For retail investors, this offering signifies an accessible and budget-friendly vehicle, ideally poised to navigate the intricate landscape of value investments. 6. Land and property, a fortress against inflation. Within the financial realm, accountants hold land in a unique regard, an asset immune to depreciation. This status finds its roots in a profound scarcity, rendering land an enduring and sought-after resource. Across the annals of time, it has maintained its distinction as one of the globe's most prized possessions. As civilization marches forward, land persists as a bedrock essential for homes, schools, factories, agriculture, and commercial enterprises. With the human population continuing its expansion, the demand for land remains insatiable. Moreover, this principle cascades onto the residential homes, office spaces, and commercial properties that grace its expanse, each an eternal epicenter of demand. Thus, both land and real estate function as stalwart guardians against the erosive tides of inflation, nestled securely within your investment portfolio. Quantitative evidence corroborates this assertion. Referencing a Bloomberg analysis, housing prices burgeoned threefold from 1992 to 2020, an astonishing feat even amidst the tumultuous dip of the 2008 housing bubble. This narrative gains pertinence as the dollar's value experiences erosion. Yet, for many modest investors, real estate enters their sphere of consideration during later stages of life, often pigeonholed solely as the home they inhabit. While ownership of a fully liberated domicile may mark a net worth milestone in one's 40s, a foothold in the retail property domain is an asset with universal applicability. Contrary to prevailing assumptions, acquiring real estate exposure doesn't necessitate a substantial fortune. The avenue of real estate investment trusts, REITs, presents itself, a kinship with mutual funds, but tailored to the real estate realm. Stateside, the illustrious Ventus Inc. (VTR) stands as a preeminent example, channeling investments into healthcare real estate, spanning senior housing, research facilities, hospitals, and more. Alternatively, the prospect of leveraging to acquire rental properties emerges. In this scenario, the rents earned not only defray expenses and mortgage obligations, but also usher in additional profits. 7. The world of treasures. Venturing into the realm of collectibles unveils a captivating landscape encompassing vintage cars, exquisite artworks, artisanal luxury handbags, limited edition watches, and even the inaugural prints of iconic books. This intriguing realm constitutes its own distinctive asset class. When it comes to a conventional automobile, its value spirals downward by half the instant it graces the road. However, vintage cars defy this trend, mirroring fine wine's trajectory by appreciating in value over time. A case in point. A 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe, a rarity with only 2 ever produced, commanded a staggering €135 million in a 2022 sale reported by Autocar. This exceptional feat underscores the status of such automobiles as prized collectibles in the eyes of automotive enthusiasts. Likewise, the audacious acquisition of Leonardo da Vinci's enigmatic artwork, Salvator Mundi, resonates powerfully. A Saudi prince secured this masterpiece at a Christie's auction in 2017, shelling out a monumental $450 million. What propels affluent individuals to commit significant sums to limited edition items is the inexorable timelessness of these artifacts as repositories of value. Their potential to command astronomical prices hinges upon the encounter with the ideal buyer. Yet, for the average investor, the notion of delving into collectibles can feel as distant as a reverie. Hence, digital marketplaces like Whatnot emerge as stellar conduits for trading rare baseball cards, comic books, action figures, and more. Furthermore, For those unable to acquire the entirety of a coveted item, platforms such as Convoy and Masterworks offer avenues for fractional ownership, imparting accessibility to the realm of collectibles. By understanding the true nature of money and the options available to you, you can break free from the cycle of wealth erosion. If you found this video informative and thought-provoking, don't forget to give it a thumbs up and subscribe to our channel. Share your thoughts and questions in the comments below. We're here to help you on your journey to lasting generational prosperity. As you embark on the path to financial empowerment, remember that knowledge is the key to building a legacy that spans generations.